Right. Hi, Alex. It's 18:30, so eyes down, look in, as they say. Give me the job. All right. Well, welcome everybody. Tonight is Consolidated Accounts, and I mentioned this last time. Before we start, you will need, ideally, you should have a copy of the data and the blank templates, especially the data. And if you haven't, there is a link under my picture at the webcam to a PDF. So if you help yourselves to that, ideally as well, if you've got your notes from part 3, a couple of the figures we will be revisiting, although we'll be working for everything tonight. Okay, so can everybody hear me okay just before we launch in? Grand. Excellent. Thank you. Okay, so it's part 4 in our mini series of 4. We did the building blocks of goodwill when one entity acquires control of another. We looked at intergroup transactions and the unrealized profit that we sometimes have to adjust for. Those are the first 2 sessions. We will be meeting both of those again tonight. Last week we looked at the first of the 2 final accounts, the consolidated statement of profit or loss, and tonight we're finishing with a consolidated statement of financial position. Very popular with examiners, very unpopular with the rest of us, but it's one that we almost certainly we're going to meet, so we need to know. Okay, so consolidated accounts, final part. I've just said all this bit, haven't I? First job, like we did last week, we'll start by laying out the template. Now there's a lot of boxes on a statement of financial position, so we'll do it in 2 halves. And we'll start with assets, non-current assets, tangible and intangible. Current assets, which in this case I can see inventories, receivables and cash. And then total assets, that will be our top half. So first item, tangible assets, they're straightforward, we just have to add them together. So if we look at the data, sure enough, we can see here we've got 1280, these are all in thousands for Ginger, 440 for Baker. Simply add the 2 together, 1720. So far so good, that was a straightforward one. Nice easy warm-up. The second item, intangible assets. Now there are 2 things we need to think about here. First of all, there's already an intangible asset on the statement of financial position for the parent company, Ginger plc. And that is described as an investment in a group company, and it's £400,000. Now, remember that the whole principle underlying group accounts is that we only detail in the accounts those transactions and relationships that extend outside the group. So this item is the holding company's, the parent company's investment in the subsidiary. This exists entirely within the group, and so we simply ignore it. But we will come back to that figure in a minute because that figure will be needed. So because it doesn't involve anybody outside the group, we ignore it, but we are interested in the goodwill. So for goodwill, we need to look at the price that was paid for the control of the subsidiary. We need to compare that with the value that was bought. And there's a difference between the 2, which we call goodwill. And note B in the extra information tells us that this must be amortized at a rate of 10% per annum. Amortization, why we have to have a different word for intangible assets to the depreciation we apply to tangible assets is anybody's guess. So we have paid a price, we're back to this again, we've paid a price of £400,000. So that's first element in our working. Now we need to look at the notes. Ginger has acquired 320,000 ordinary shares, that's the second element. Baker's retained earnings at that date stood at £50,000 because we're having to measure the goodwill against the value that was bought at the time of acquisition, not today, which might be 1 year as it is here, or it might be 10 years later. Thirdly, a reminder that goodwill is to be amortized at a rate of 10% per annum. So if Ginger has bought 320,000 ordinary £1 shares, we need to know how many shares that is out of the total. So if we look at the data again, sure enough, the equity of Baker Limited comprises 400,000 £1 shares. So put these together. The holding, 320 out of 400, that's an 80% holding. What we've bought is 80% of share capital, retained earnings at the time we bought it, that's 450, 80% of that, 360. Take 360 from 400. Our goodwill is 40,000, and we are going to amortize that by 10% because it is 1 year since the acquisition took place. So 10% of 40 is 4. Take 4 from 40 leaves 36. And now we can calculate our first subtotal. 1720 and 36. 1756. So far so good. If I'm going too fast, do shout up. And if we're all happy, we'll move on to current assets. First of these is inventories. Now, we have to remember there's an unrealized profit, which we'll look at the detail of again. But this affects the value of our closing inventory. The inventory for one of these organizations isn't worth as much as they think it is because the price they paid was a higher price than the items in question were first bought into the group at. One group member bought them from outside at one price, added a profit, sold them on to another group member. And because they are still in inventory at the end of the year, we have to adjust them down to the value that they first came into the group at. So, looking at note C, we've got Baker made sales to Ginger, so the subsidiary made sales to the parent entity, totaling £240,000, which included a profit margin of 25%. And at the end of the year, 1/6 of these items were still in inventory. So, 240,000 times 25% divided by 6 gives us 10,000. So the inventory of the group as a whole is worth 10,000 less than it is currently recorded. Let's go back to the original data. Inventory, Ginger PLC is 300,000. For Baker it's 250. So what we're going to do is add those two together, take off the 10. Group inventory is valued at 540. Next item down. Next asset is receivables. Again, there is going to be an adjustment because some of the money that is owed to one of the group members is owed by another group member and not owed by somebody outside the group. Back to the data. Item D. At the end of the year, Ginger owed Baker £40,000 in respect of items bought. You'll notice, by the way, the original statements are all summarised into whole thousands, whereas the notes are not. Questions are almost always worded this way, so do watch out carefully to know what's 1,000 and what's not 1,000. It's easy, and you'll see this in our assignments, it's easy to get mixed up with thousands if you don't read it carefully. So, 40,000 owed. Let's look at what the receivables are in total. Ginger's stand at 280, Baker's at 150. Let's go back to the diagram that we first drew when we first started looking at these statements, the working tool that I've always used to sort out every one of these adjustments. Here's our group. There's Ginger, the parent company. There's Baker, the subsidiary. Ginger is owed 280,000 in total receivables. Baker is owed 150. Now at that they all appear to be from outside, but we know that that isn't the case because Ginger owes Baker 40,000. So now as we look at Baker's total receivables of 150, we can split that. 150 take away 40 leaves 110 that is owed by people outside the group. So the group's total receivables comprise 280 plus 150 less 40, or 280 plus 110 if you prefer. There's the working, and the figure is 390 as a result. Next item's easy enough, that's cash. Cash is just cash. Those of you who remember it, not something some of us see very often. Watch out though for a separate bank overdraft, because if there's an overdraft, that isn't part of cash, that's going to go down in your current liabilities. So from the data, 40 plus 10 is 50. We can now total up the current assets. 540 plus 390 plus 50 gives us 980. Add that to the non-current assets to get total assets of 2736. So far so good. If everybody's happy, we'll press on, and now we'll draw the equity and liabilities template. This time with ordinary share capital, share premium, retained earnings, non-controlling interest. What isn't present in this particular scenario is a revaluation, but if there was, there might be a revaluation reserve in there, but there isn't on this occasion. Those together will give us the total equity. Non-current liabilities, we can see bank loans. Current liabilities, we can see trade payables, and of course our old friend taxation. From that we'll get our total liabilities and our total equity and liabilities, and if that matches what's at the top, we can all be happy and go home smiling. So, first item, ordinary share capital. This one's easy. We take only the parent company figure, which from the data, 800 from Ginger PLC. In it goes. The same is true of share premium account if there is one. Again, we've got 200 only from the parent company. Now, retained earnings. This gets trickier. There's invariably a working, and in this case there will be a three-part working. We'll start with the retained earnings of the parent company from the statement of financial position. We then have to add to that the parent's share of the profit that has been earned by the subsidiary since the time of acquisition. Whew, that's a gobful. And then finally, the third element here is that any amortized goodwill will be subtracted from the retained earnings. Watch out for an example that says the acquisition took place 2 or 3 years ago, because you need to subtract 2 or 3 years worth of goodwill. In this case it's just 1 year, but do watch out for that. So, retained earnings of the parent, first item, nice and easy, 860, there it is. In it goes. Now the parent share of subsidiary profit since acquisition, this also needs its own working. So we need to look at what the profit was at the time of acquisition, compare it to what the profit is now, and then what we'll do is calculate the parent percentage share, which is 80%. So from the data, this is the layout we're going to use, the holding percentage, and then the earnings now, the earnings before. Now the notes tell us that at the time Ginger acquired 320,000 ordinary shares, the retained earnings balance stood at £50,000. So 50,000 is the figure we're really interested in here. The 320 is just a reminder that 320 over 400 is 80%. As at now, on the present statement, Baker Limited's retained earnings stands at 100,000, but there is a catch. That is definitely the profit that Baker Limited has retained, but in group terms, 10,000 of that profit is currently residing in Ginger's inventory as unrealized profit, so we will need to adjust for the 10 that as yet has not been sold on to outside customers. So 320 over 400, 80%. At acquisition was 50,000, is now 100,000 minus 10,000. So the parent's share of post-acquisition profits is 80% of 100,000 minus 50,000 minus 10, which is 32,000. In it goes 32. Amortized goodwill, well, 40 was the goodwill. 10% of that, 1 year is 4, which gives us 860 plus 32 less 4, 888. So that's our next box filled. Final item in equity, non-controlling interest. This is one that is always made to look a lot more difficult than it needs to be. In simple terms, if there isn't any adjustment for unrealized profit or the like, you simply look at the reserve, at the reserves, the equity and reserves of the subsidiary, and multiply it by the percentage that you don't own. So if your subsidiary is worth 1,000 and you own 70%, the minorities, 30% of 1,000 would be 300. It really is as simple as that. This one's a little more complex because of that unrealized profit. So equity of the subsidiary, there we see 400 share capital plus 100 retained earnings. So 500 is the equity of the subsidiary. But then we just need to adjust that by the 10 to leave 490. We own 80%, therefore the other shareholders, the minority interest, now called the non-controlling interest, 20% of 490 is 98. In it goes. So our total equity for the group is 1986. So far so good. Okay. Now we move on to non-current liabilities. And the only items present in this scenario I can see are bank loans. Now there are no banks within the group. They're definitely outside, so all we've got to do, pick them out. Ginger owes their banks 200, Baker owes 150. Put them together. The group in total owes £350,000 to its bankers. Current liabilities. 2 items here. Trade payables. You'll recall that we had to make an adjustment to receivables because some of the money owing to Baker was owed by Ginger. This means that some of the money owed by Ginger is owed to Baker, so the identical adjustment takes place. This is how most group adjustments don't affect the overall total of assets and liabilities because they cancel out. So this was, there we go, payables 130 owed by Ginger, including 40 to Baker, 160 owed by Baker, less item D, 40,000 owed internally. So 130 plus 160, take away the 40, gives us 250. Final item is taxation, which all goes, of course, to the tax man. We don't get to keep any of it. So all we do, tax liabilities 110 and 40, simply add them together, gives us 150. We can now add up total liabilities, which is 350 plus 250 plus 150, 750. Add that to our total equity to get a total equity and liabilities figure of 2736, which does indeed match the figure we had for total assets. Now, hopefully what's come across so far is no one single working day was that complicated. What you have to know is what to include, what to miss out, and which items to adjust. I've got just a few thoughts to round off with. Tangible assets, you just add them up. Just watch out for a revaluation if there is one. Other than that, it's very straightforward. I recall that well as being the only bit I could ever do when I first met these. The rest of it, but the tangible assets, they were okay. Intangible assets, normally it'll be goodwill. There could be, a group could have a parent entity, as well as owning this subsidiary, could have further investments in businesses outside the group. So watch out for that. That's mostly it. Obviously, intangible assets include patents, trademarks. I don't think an examiner is going to be mean enough to include patents and trademarks in a consolidations exercise as well. Let's hope not. Intergroup investments, so mostly it'll be the parent company's holding in the subsidiary is ignored because it's within the group. Inventories are added up, but they are affected by unrealized profit because the unrealized profit part of the inventory valuation has to be deducted. It's just any inventory that is still unsold at the end of the year. Receivables and payables are both net of intergroup debts, and those two adjustments cancel each other out. Share capital and share premium are taken from the parent only. Retained earnings is the tricky one. There's invariably sort of 3 or 4 elements to that, but each element is, if you're methodical, is very logical. Non-controlling interest, this is the one that always looks so much harder. It is simply the minority percentage of the equity of the subsidiary with any adjustments, as we had one today. But normally it's just 2 figures. And again, loans, if there are loans outside the group are counted. If any money is owing, if a parent has funded a subsidiary with a long-term loan, that is also ignored. And if the top and the bottom come out the same, you can relax. It means you've got it right. It only remains now for me to say, if you've any questions, please fire them in now. The notes for all sessions we will be sending out now that the whole series is finished. And it remains only for me to say, well, thank you for listening, and I hope that tonight was worthwhile and has hopefully cleared the fog for you a little. Might we see a consolidated in the synoptic? A good question, Alex. It's not out of the question. Generally, the technical questions in the synoptic are a bit lighter than you would get in the main financial statements exam. So I think that's probably not. Okay, my job now is to switch off, and thank you and good night, everybody.